Welcome back to another episode of Fire Trail, the show that's all about helping you achieve financial independence and retire early. I'm your host, Xiao Yu, and today we're going to delve into a crucial concept that every investor should understand: the importance of time in the market rather than timing the market. You've probably heard the saying, it's not about timing the market, but time in the market. But what exactly does this mean? And why is this so essential for successful investing? Well, we're about to explore that in depth. To get started, let's begin by explaining what we mean by timing the market. Timing the market is the practice of trying to predict when stock prices will rise or fall and making investment decisions based on these predictions. It involves buying low and selling high to maximize profits. While it may sound appealing, it's important to note that timing the market is notoriously difficult. Studies and historical data have consistently shown that even the most seasoned investors and financial experts struggle to consistently time the market correctly. Market movements are influenced by a myriad of unpredictable factors, such as economic events, geopolitical developments, and even unexpected news. This complexity makes it nearly impossible to consistently make precise predictions. So, if timing the market is so challenging, what's the alternative? That's where time in the market comes in. Instead of trying to predict market movements, the strategy is based on staying invested over an extended period, allowing your investments to grow over time. The concept of time in the market is grounded in some key principles. First and foremost, time in the market allows you to benefit from the power of compounding. Compounding is the process where your investments generate earnings, and those earnings in turn generate even more earnings. The longer your money is invested, the more time it has to compound, and this can lead to substantial growth over the years. Next, time in the market also helps reduce risk. When you invest for the long term, short term market fluctuations have less impact on your overall portfolio. It allows you to ride out market volatility and recover from downturns. Furthermore, diversification is another key aspect of the time in the market strategy. By spreading your investments across various asset classes and sectors, you can lower the risk associated with individual stocks or assets. Diversification can help protect your portfolio during market turbulence. Now, let's explore some practical examples to illustrate the importance of time in the market. Imagine you decide to invest $1,000 each month in a particular stock. If you try to time the market, you might purchase the stock when it's at its highest one month and its lowest the next month. On the other hand, if you employ a time in the market approach, you consistently invest your $1,000 every month, taking advantage of dollar cost averaging. This strategy helps smooth out your purchase prices and can result in better long term returns. Let's also consider historical data. The S&P 500, a benchmark for the US stock market, has delivered an average annual return of around 7 to 8% adjusted for inflation over the long term. However, these returns are not evenly distributed year by year. Some years the market is up significantly, and other years it's down. By staying invested in the market over time, you have a much higher chance of benefiting from these returns. So, how can you apply the time in the market strategy in your investment journey? First, it's essential to define your investment goals. Whether you're saving for retirement, a major purchase, or your child's education, Understanding your objectives will help you determine your investment horizon. Next, work with a financial advisor or do your research to create a diversified investment portfolio. Diversification spreads your risk and increases the likelihood of long term success. Stay informed about the financial markets and your investments, but resist the urge to make impulsive decisions based on short term market fluctuations. Emotions can often lead to poor investment choices. Periodically review, and rebalance your portfolio to ensure it aligns with your goals and risk tolerance. This might involve selling some assets that have performed exceptionally well and buying others that are underperforming. In conclusion, the importance of time in the market is a fundamental concept in successful investing. Rather than attempting to predict market movements, focus on staying invested over the long term, taking advantage of compounding, reducing risk through diversification, and ultimately working toward your financial goals. Thank you for tuning into this episode of Fire Trail. If you enjoyed this episode, don't forget to subscribe to the podcast and leave us a comment. Thanks for listening. This is Xiao Yu, wishing you all the success and happiness on your financial journey.